Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Sridhar Sannidhi. And he has worked in the IT industry for 30 years in various roles and is in real estate investing and has more than 30 years experience. Commercial real estate developer, syndicator, and a general partner in 2,000 plus multi-units. Are those apartments?
Yes.
Okay, perfect. All right. Well, I'll start with really how I start with every guest, and that is, where you grew up and what led you to real estate eventually. Tell us a little bit about your journey.
Sure. I was born in India, and I did my undergrad education there, and then I got the opportunity to come to US on a work permit. It's pre-2000 Y2K, pre-Y2K. That time there was a tech specialist shortage in US, and there was a lot of work permits were given. So I got lucked, and then I came to this country. And in 95 I came. Initially I was in Silicon Valley, working on like mainframe to client server conversions and technology. Say those who are familiar with technology,
Nice.
Right? Big old mainframes. Later, I moved into internet and then all the latest and greatest cloud technologies, etc. After staying there for 1.5 years in Silicon Valley area, I relocated to New Jersey and worked in Wall Street for 18 plus years in all the financial firms, the big ones. And 10 years back, I relocated to Dallas, joined large tech firms like Oracle, and then later Google. So recently I exited from Google in January, and I'm a full-time commercial real estate developer, syndicator, etc. So my journey to real estate started 20 plus years back. At that time I was mostly buying like apartment and small lots, etc., mostly abroad. So in domestically very little. So 5.5 years back, I thought of building a portfolio with single families, and initially there was a lot of competition, so I could not buy any single family. So I decided I should go for big and bold and started exploring other commercial opportunities, hotels, motels, warehouses, and then multifamily. I bumped into one mentor at one of the real estate event. I felt very comfortable with multifamily, and I thought I should go and check it out. So initially I invested in passive mode for a couple of deals. After seeing the first check, I thought, okay, there is some potential here. Let me go full-fledged active role. That way I will have more knowledge on the business and then also under control. So that's how I started my journey. And after buying the first one, syndicating the first one, I was able to raise the money easily. Then I thought, okay, this is something I can do. So let me start doing more syndications. And in that process, I challenged myself. In last 5 years, I did, I think 18 transactions as a general partner.
Okay.
So then roughly 3,800 plus doors. I was a GP, but we exited few doors. At the moment, I have 2,000 plus existing ones and 660 plus the new developments. So total 2,700 plus units I have currently.
Okay. There's a lot there. So when you went to work for some of the financial industry, was that all still under kind of the IT, or did you completely shift gears?
It's mostly on IT side. I was not on the core finance, but we were closely supporting the core finance. So I know more core finance things.
Yeah. Okay. And so when you were out in Silicon Valley and then New Jersey, when did you buy your first like investment property?
The syndicated first investment property was in 2019 January. The first one.
Okay.
So we started the process in 2018 towards the end, and then closed in 2019 January. Yeah.
Okay. That's great. And before that, though, did you have any that were under just yourself before syndicating?
No, I invested in a couple of deals, but I didn't do anything as a major partner. Yeah.
Okay. Oh, those were all LP deals that you did first before that. Okay. Makes sense. Tell me, I guess, a little bit about maybe that first one that you syndicated. Who was part of your team and where was it geographically? How many units? What was the strategy on it?
Yeah, it was a 96 unit property. Out of 96, I think 40 plus units were down. The owner wanted to completely gut them out and then rebuild it, but he ran out of cash. So he sold as is. So we bought it for $3 million, and then we raised close to $1.2 million. It is in Wichita Falls, Texas. Still we have it. We did not exit on that. So it took a while for doing all that remotely. So, that's a very good learning experience. So luckily it's a smaller project and we could handle it. So we were able to bring all the 40 plus units online. Now it is fully occupied, stabilized. And now we are looking for the right exit time. So we raised 1.2 million, myself and two other partners. One of them is my friend for a very long time. The other one is, we met him at the event, real estate event. So we formed the team and then we bought it. Yeah, it was very good experience. So I didn't think that I could raise the funds, but luckily I was able to raise most of the funds in that day.
Okay.
And then
one question about that one. So it sounds like because the prior owner was, kind of redoing quite a few of the units, 40 of the units. So what was the occupancy when you purchased it? Was it like 60% or?
It's around 70% occupied.
Okay.
Around 70% occupied. Even though he was planning to do the 40 units, all the units were not completely down. They were occupied, but they want to cut down, completely gut it down and then redo it. So 12 units were completely down. Basically they pulled up everything and they were working on it. So they were doing in batches. So that particular batch, the 12 units were completely down. So
yeah, that's an intro. I mean, a lot of times you'll take on a value add deal, but one that you're, having to go in and do quite a bit of extensive work on each one is interesting. I'm sure there were some lessons that you learned kind of along the way. What were some of the biggest aha moments, or just, maybe everything went as planned, but what did you see on that first deal that kind of has helped you for all the future ones you're doing?
So, first thing, obviously, when we do very first time, right, you will see cost overruns. We face the cost overruns for the deal. So our estimations were wrong because what we went with on our estimations later on when we saw that what we need to do. So ended up creating that gap. So we ended up spending more money. And second thing is when we work with these small suburbs, right? The building codes and all are different. So they have their own way of working things. So they gave us a little bit of tough time on doing things. So, for example, electrical work, the contractor did it. And then he thought that he would get the inspection, and then he put the sheetrock, and then we went for the inspection, and the inspector came and said, no, you pull out all the sheetrock and redo it, and we will inspect them. So we had to do those kind of things. So those are the contributions for cost overrun. So that one we learned the hard way. But the contractor said that, hey, everywhere else I was able to do this way. So, but here in Wichita Falls, they didn't allow me. So it is how it is, right? So that those kind of things we had to face. And obviously remote execution is a little bit tough compared to local. Wichita Falls is 2 hours drive from Dallas. So the contractors are limited number available there. So we had contractors go from Dallas to do the job because we wanted to do it quickly. The local staff doesn't have the bigger crew to handle this kind of job. So we had to go in that mode. And then there's a lot of planning involved in that. So we had to make sure that the materials are there, and then they were able to go on time and execute it. Otherwise, they will be sitting idle there. So those logistics were a little challenge in that. But end result was the units came out really nice. That's good.
I was going to ask on your on the contractors, how did you do that? If it's like a 2-hour difference, right? You said it's about 2 hours away to Wichita Falls from Dallas Fort Worth, and so the contractors, were they driving in each day, or were they coming in like on a Monday, leaving on a Friday? And what kind of preparation did you have to do as far as housing and stuff while they were doing their work?
So for sheetrock and all, and that's what they did, Monday to Friday type of thing. And then in 1 or 2 other trades, we gave them a couple of vacant apartments. They could stay there and then finish the work like that. For 1 or 2 trades that they were doing Monday to Friday, and then they quickly finished it off like that.
Okay. Yeah. That's is that a practice that you've kept on future deals as well, as far as using the same contractors? I'm just thinking, on my own business as well. And, obviously if you're used to using a crew, then it takes away some of the, is this going to be a good contractor? Is this not? But, I imagine it's a bit of a challenge to try to get somebody that's willing to leave their family during the week to go and be on the job site and then come back on the weekends. Is that something you still do on your future?
No, now we have new other contractors, but mostly in the similar mode. They do by themselves. We don't offer anything, but they include those costs into the bid. So we try to create local. That is the only project we have like heavy lift as far as redo. But other units, right? Other capexes, we do have a crew, local crew. For example, we have properties in Dallas, so we use a Dallas crew, so it's not a problem. We don't need to worry about Monday to Friday. Only 2 properties we have in Wichita Falls. So one is a normal upgrade, so we don't have any issue. This is the only one we had to do massive capex. Okay. Now we bought another one in Houston now, so we are trying to simulate the similar model. We are trying to take the contractor from Dallas now. Of course, they has a crew, some local crew in Houston. So hopefully we will balance it out that way. The management will happen from Dallas and then crew will be from Houston or something like that. So, yeah.
And on the different parts, sounds like you got 2 in Wichita Falls. You have quite a bit in the Dallas Fort Worth area. Then you got this one in Houston. Where else geographically are you investing?
So we have 3 properties in Houston, 1 in Austin, We used to have 4 in Dallas, but now we only have 1. And then 1 in Memphis, Tennessee.
Okay.
Yeah. So
What,
we're expanding to other Sunbelt states. Yeah.
Okay. Yeah, because all of them being in Texas, and I guess Texas is an amazing state. We both obviously live here in Texas. The killer though seems to be property taxes. It's such a big factor on cost compared to other states. So what is there a difference? What's Memphis like from property tax standpoint? Is it substantially lower, or is it kind of in the same ballpark?
Generally, it is lower. On top of that, there was some incentive given by the city in Tennessee.
Okay.
So whenever there is a massive amount of investment done on a property, right, they give 10-year tax break.
Okay.
So we have a program called pilot program. So we pay $100,000 per year on taxes for a 400 plus unit property.
Oh, wow, nice.
So the same property would have been like $1 million to $2 million property tax in Dallas, depending on where it is situated, right, and the income level.
Yeah, no kidding. I'm sure there's stipulations. Maybe there's not, but what do you have to keep rents at a certain range in order to take advantage of those tax? Or is it because you're investing in, say, like an opportunity zone area, or what's the purpose that what's nice about any kind of tax break is, that government will incentivize you for things that they're hoping the investors will do. And so I'm just curious in this particular case on the one in Dallas, kind of what the motivation is there from the city.
So the one in Tennessee, the incentive is basically the previous owner spent $17 million on the property. Since they were spending $17 million, you got the tax break on it for 10 years. So that was the main thing. So after 10 years, it gradually catches up for another 10 years.
Okay.
So it's a 20 years tax advantage.
Yeah.
So there's no restriction on rent. It's just pure incentive for investing large amounts. Okay. In Dallas, yes, we do have, buildings going on, right? Construction going on. We do have the opportunity to incorporate some of the tax incentive style program into the construction deal. But we didn't opt for it because the moment you do it, then we need to give some percentage of units at restricted rent levels. We don't want to get into that restricted levels.
Yeah, makes sense. And so so from that initial first one that you invested in, you were working, I'm sure, with some other GPs as well. Maybe that's a bad assumption, but I would assume that there's, some others. Is your team pretty much the same since that first one, or has it changed up quite a bit?
No, every deal is different partners.
Okay.
So, because there are several reasons. One, geographically, each deal is in a different city, right? So we try to bring in a partner who is local there. Just kind of boots on the ground. And then another thing we look for is the size of the deal. If the size of the deal is big, like 400 plus units, then obviously the fundraise will be more. So we'll add more partners to the deal.
Right.
That. So like that, we have anywhere from 2 to 7 partners in a deal.
Okay. And what about property management on that? First one, are you using the same property management company for the 2 that are in Wichita Falls? Do you use the same on all of your portfolio, or is it kind of geographically specific?
So we are using the same guys now. So earlier we used to have a different company and they didn't run properly. So we changed the property management company. They manage 5 properties for us out of the portfolio. In Dallas, Houston, and Wichita Falls. We go for third-party property management. We are not looking into doing vertical integration yet. Maybe next year or following year, I will start working on it. At the moment, we want to do more focus on the CapEx somehow try to bring into our own in-house CapEx style. So we are working on that, building that whole company, CapEx company. We can use it for our own properties as well as for other GP syndications. So we are building that business. So we source the material directly from manufacturers, and then we have a team to execute that construction piece of it. So that way we will reduce the costs to maximum extent on CapEx. So once we streamline all these CapEx processes, right, the next thing we would do is like vertical integration. By then we are planning to buy 1,000 doors next year. So once I have 1,000 doors in Dallas, then I can start vertical integration in Dallas.
Yeah. No, that makes sense. I think that's a good number too to add to your portfolio, and then that really makes sense. It works really well for some folks when they have it vertically integrated. That's neat to hear that you're doing the kind of vertically integrated CapEx stuff. So give me maybe some examples of the kinds of materials and things that you're getting directly from the manufacturer. I mean, is it everything associated with turning an apartment unit and updating it, or are there specific things that you're really focused on with this CapEx improvement?
So at the moment, we are going with a limited number of items. Eventually, we want to get as many as possible. When I say limited number, right now we are focusing on flooring. Okay, flooring is one thing, and then cabinets type of things. Also, we are getting in granite countertops, Korean countertops, and all that. We are going for direct, and then faucets. Some of the plumbing supplies we are going directly. Painting at the moment we are sourcing locally, but we eventually want to see if there is something we can source directly from manufacturer on that and save some money. That is also another thing we are looking into. Other than that, I think at the moment we're not looking into anything else. The CapEx improvement.
Those are a lot of the big ticket items, and so it makes a lot of sense. That's neat that you're doing that. Have you already started doing that with like your last project, or how long ago did you start?
This is the first project we are doing right now in that mode.
Yeah.
So we are projecting anywhere from 25 to 40% savings.
Okay. Yeah, that's huge.
Yep. So when we have a CapEx budget of $2 million, that is like significant. That allows me to upgrade more units. So
right. No, that's neat. That's cool. It's always interesting to hear, how different people are kind of structuring their business and some of the efficiencies that they can find in it. I mean, because at the end of the day, it all equates to more money for the investors, right? So that's great. Fantastic. Tell me a little bit about you're doing some development stuff as well. So these are from ground up from apartments. Is that correct, or what does the development stuff look like?
So it started with the ground up apartments. So we have 306 unit being built in Princeton, Texas. We are going to start another 330 unit apartments in Melissa. And now I'm venturing into other commercial spaces. Now we have another land development for single family lots. That one is going on. And then we have 20-acre mixed use development in Austin for a hotel, retail, and then townhomes.
Oh,
so
wow.
Slowly venturing into other projects like that. So.
Yeah. Oh, that's cool. What are some of the things that are different when you're doing a development from the ground up, whether it be apartments? I mean, maybe we can look at just apartments. Obviously it's a different business plan. When do you get the investors involved, and is that from the beginning? And if so, how long are you expecting to hold on doing any kind of distribution? Obviously, there's construction timeframe. Just curious about kind of the dynamics and how they're different compared to a normal value.
I mean, this apartment Existing apartment acquisition, usually it happens quickly the moment you are into PSA. That's when you start raising funds and then close it, right? Whereas the new construction, we do it in 2 phases, because the first phase is obviously we need to go through the entitlement process and permitting. So at that point, we buy the land, we go through the entitlement process. So we raise phase 1 for that until the entitlement process is done. That would be a smaller raise. And once the permitting is done, at that point, we create a new LLC, and then the new LLC will buy this entitled land. And we give the opportunity to all the first phase investors to roll into this one with the market rate appreciation. Basically, after the entitlement is done, we get the broker opinion on how much it would be, and that would be the basis for that land for into the new project. So we give that much of return to first phase investors, and from second phase they will have a new set of investment. That's what I can say. Usually the construction would be around 24 months to 30 months and another 6 months for stabilization. So usually 3 years to 3.5 years project.
Okay. And how long on those are you intending to hold on those projects?
So at the moment, we are planning to exit post-construction. But going forward, I'm changing the model. So whatever I start in 2024, most likely I will hold them for 10 years.
Okay.
Maybe the option for investors to exit within 3 years after construction completion. So as soon as the construction is completed, the investors can exit out of the deal if they don't want to continue on that. So if they want to continue, they can stay in it. So
that's good. I think that's neat to give the investors options when it comes to that. Not everybody, will want to part with their money for 10 years. But to me, I think, if you're playing the long game, that's really the way to go. Because otherwise it's so transactional, trying to do something and then turn around and do something else.
Yeah. I agree.
Yeah, and that's neat. I haven't heard that before about, giving the investors the opportunity to roll in, so going through the entitlement process, taking down the land and everything, and then giving them the opportunity to stay in. Is the structure where they're just getting the payout at that time when construction starts and, the purchase is made by the new LLC?
Yes, that is correct. So typically from the raw land to entitlement, they get 25 to 40% return in 1 year. So that will be added to their principal, whatever their principal investment. And then that becomes a new base for them in the second phase, in the construction phase. Typically in the construction phase, they get 80 to 100% return in 3 years.
Okay. Yeah, that's great.
So
what is, how long, and I know it's going to vary, from location to location, depending on, who you're dealing with, but, your typical, I guess, entitlement process, from start to finish, how long does that normally take?
So best case would be 6 months, but I have not seen best cases. So I would say 9 months to 15 months range is the most practical time frame, I would say, and depending on the township, anywhere from 9 months to 15 months.
And I want to say I just read something recently about a change in law. Maybe it was a local law, but that helps with that entitlement process and kind of speeding it up. If the city doesn't respond or the counties don't respond within a quick enough amount of time. Have you heard anything about that? Or
yes, for some from certain provisions like 30 days. So within 30 days, if the city doesn't respond, you have automatic approval kind of thing.
That should be huge. That because that's fairly recent, but that should be good to just kind of speed things along, because it is, the more I have these conversations with different people, whether it be the eviction process or whatever. I mean, it varies so much from state to state, from different governments. It's kind of crazy how all over the map it is. So it'd be nice to be able to say, hey, look, we're going to give you enough time, but if you can't get it done in this time, it's an automatic approval.
Yep.
Yeah, that's neat. And so tell me a little bit about, like, maybe, obviously we're in kind of a different market, and so tell me a little bit about maybe how things have changed for you, since the increase in interest rates, how maybe your strategy has changed. And then I'd like to hear also, I know we don't have a crystal ball, but I always like to hear, kind of your thoughts on what you expect to happen over the next 5-10 years.
Yeah, that's a very good question. So, market changes continuously. It's always some change happens, so we need to be ready with all kinds of changes. Yes, I do have a couple of deals that I took variable interest rate loans. So obviously the rates have gone up. We have rate cap. We bought the rate caps, but the challenge is the lenders want us to escrow money for future rate cap purchase already, and that future rate cap purchase escrow amount is large enough that creates a negative cash flow on the deals, negative net income, right? So that stress is coming on a couple of deals because of that escrow money. So at the moment, the GPs are pitching in for that shortage, but unfortunately, we had to suspend distributions for investors because of that reason. Those things, I'm looking to refinance them and then clear up all that so that I will not have that burden. So I'm working on the refinance. Even the refinance market is tough now for a couple of reasons. One, the LTVs are low now. The banks are not giving the same LTVs that what they used to give last year, like 75 to 80%. Now, rarely you get 75 to 80% LTV loans. So that is one challenge. And second thing is, cap rate on these properties. Right now, they use arbitrary number. Earlier, they used to have more tighter numbers on cap rates. Now it's more like, some properties sold at C-class property at a higher cap rate, so I would only take that one type of thing. That you need to argue with those guys and say that, no, it's not like that. This property is different. So use this different cap rate type of thing. So as a result, the proceeds will go down. So then it becomes a cash and refinance. Those challenges are there. So going forward, we'll only go for the fixed interest rates, even if it is higher rate. We'll go for fixed interest rate. If the deal works with that, then we'll do it. And also we are changing the overall structure. One of the challenges we had is like whenever we need funds quickly, raising the funds to retail investors is always time consuming. So this year we launched a fund. I'm part of the fund and one of the fund managers, our COO, you can call it. So that allows me to take or tap into the funds whenever I need, so that quickly I can close the transaction and restructure the finance. That's another big plus for me going forward. So I can structure more favorable mezzanine debt in the fund structure. So if I go with...
So is that kind of what the fund is? Is it like a mezzanine type debt that you can access?
It's a fund of funds. Yeah, it's fund of funds. Mezzanine debt is one of the options in that fund. So other things is the fund can be a GP on a deal. So there's also, this is like fund of, then we allow investors to come through fund, and then the fund itself be a GP on a deal. So
that's really interesting.
Yeah. So, or if they want some fixed interest income, then they can go into the debt fund, and debt fund is mezzanine debt to these deals. So that allows me to go for advanced finance structures in getting a deal where normal financing won't work, right? So then we acquire the deal, we improve it. After a year or so, we refinance and release the mezzanine debt. And the biggest plus is, since we are going to structure the mezzanine debt, the rate of return for the equity investors would be much higher than normal.
On that, so from an investor standpoint, somebody investing in this fund of funds, is it structured just based on a preferred return that's based off of like what the interest rate is earning, or I would assume there's not like a multiple at the end. It's just, once the debt's returned, then the preferred return stops, or they're out of the deal. I guess maybe.
No, it has like a couple of steps. Like basically in the same deal, some part of it would be a fixed interest type of mezzanine debt, like a debt fund, and part could be a LP investment. Since the fund can come up with a bigger check, they will get a preferred return on that bigger check. And then rest is like any other LP returns. So that's what we are structuring. Like if I'm getting a $2 million check from the fund, then I will be at the liberty to give a little bit higher preferred return for that.
Yeah.
For equity.
Yeah, no, that's great. Very interesting.
So those kind of adjustments I'm doing, and also operationally I'm improving overall. So now I built a virtual assistant staff to get involved in the day-to-day operations and supplement the property management on site. So anything property manager is overwhelmed or they need a little help, this team will step in and they will give full support to the team. Even smallest things like if they want to create a brochure and then publish in a Facebook group or something like that, this team can help us.
Oh, that's cool. Yeah, that's good. I mean, that just kind of speeds things up for them. It doesn't require that the property manager, have to create something on their own. You're basically, hey, here's a team, whatever we need, let's do it. So Facebook ads, different things like that. But what, anything else related to the day-to-day business of the property manager that
my team helps. They create like 100+ reports for me. So various KPI reports and all that, so that I can tightly monitor on all these assets. Eventually, we are going to reduce the number of reports. 100 is like insane, but at the moment, we want to measure too many things when the market is not in good mode, right? So that's why we had a lot of reports. We're going through, and on a day-to-day basis, they do sanity checks, like very simple sanity checks, like they go to each and every property's website and they see whether the website itself is functioning or not, whether any Facebook group on the Facebook or any social media people have put any bad reviews. If they put a bad review, so that the property management responded within 24 hours or not. Yeah. Those kind of sanity checks they do. And also in tenant screening, they do check from court records and other third-party records if the prospect has any previous evictions or something like that. We want to screen those, so that kind of supplemental tasks they're doing for the property management. Even the property management has a software to screen it. So it's like a double filtering. So because sometimes the software may not get the update quickly, So we go to the court records, etc., and third-party records. We have additional handle, and also we monitor the traffic to the property and see the visibility of the deal. All those from a marketing point of view. And another thing we do is like constant auditing of the books. So because the property managers, oftentimes what they do is like back office could be one or two people who are doing accounts payables. Oftentimes they may post this one from one property to the other property to my own properties. These things need to be checked and then addressed, right? Those type of things they check, and also invoices whether they're being properly registered into the system or not. All those kind of checks and they will do. So there's a lot of back office work they do.
Yeah. What are some of the things that you're, you mentioned having all those reports that you're looking at, but maybe what are your top 3 things that you're really having your team provide you to kind of help you navigate through this weird time?
So at the moment, delinquency report is the top report. We go each unit by unit, and then we see the trends on the rent payment, and then if there are any delays and all, like who is doing and all that. So that is one thing they thoroughly monitor. And then occupancy, and then based on the occupancy, how is the traffic to the property? So let's say if the occupancy is 90%. And we want to sustain at 90%, and the notice to vacates are there, then do we have enough traffic to that? Those kind of things, right? So from an occupancy point of view, that's another KPI we constantly monitor. And then the collections. So we see how we are trending on collections. What is causing the collections delays or anything like that. Those are the main 3. And the work orders, the 4th one. So how long it is taking to address the work orders, are we falling behind, etc. So daily basis is 4 they do, but we do have a daily, weekly, monthly reporting style. Weekly, mostly the reports they do is similar to MMR reports, like Monday morning report types. So monthly is mostly it's audit. Like what we spent on and how we spent on, did we spend on the right things or not? How much we are spending, are we spending excessively, etc.
Yeah. Interesting. Okay. Wow. You got it really dialed in, and just loved hearing all the things that you're, involved in. It's great.
Well,
what about the market? So we talked a little bit about some of the things you're looking within the changing market, but kind of if you'll break out your crystal ball, what do you see happening in the next 3, 5, 10?
So I see we will get more opportunities in next 1 year or 1.5 years. We will see plenty of opportunities. So that's why I'm planning myself to be ready to acquire more properties in next 1.5 year. Market will be very fluctuating, and then the current interest rates may stay there for a while. That's what I'm thinking too, because it has not budged that much on the inflation side, right? So inflation has become very sticky. So the way Fed is saying, so which means that interest rates will be there for a long period of time. So we have to prepare for that. So those properties which are not able to sustain that, they will come on market. So that is one thing we are focusing on. And then we are going for higher median household income when we buy a new property, and we are going for newer properties. As in this market, it's easy to buy a newer property at a cheaper price. Right. So those are the adjustments we are doing for the next 1.5 year. We are not slowing down on the acquisition. We are continuing in the same pace. So obviously, we adjusted our parameters in underwriting and all, suit the current market trends and next 12 months or 18 months trends.
Okay. Yeah, very interesting. Let me ask you, is there anything that maybe I should have asked that I haven't asked? I'm gonna get to kind of how people can find out more about you, and but is there anything else that you really want to convey to the audience?
So, I mean, you could have asked why I went into development and while we are doing this one. So one of the reasons is obviously the market conditions. So in the existing deals right now, not that many are cash flows, strong cash flows. That's why we went into development. That you should have asked. Other than that, you covered everything else. To reach out to me, they can go to my website, www.growwealth2retire.com. This number 2. So growwealth2retire.com.
Perfect. Sounds good. And I've got a couple other questions for you if you have just another minute. One would just be, for somebody that's just starting out their investment journey, What advice would you give somebody that's fairly new to this?
Sure. People get scared when they first time see these syndications, and then say people really risk averse, I would say, to come into this commercial real estate segment. But to their surprise, 95+% deals are always cash positive. I mean, always winners, I would say. They're returning money rather than losing money, unlike stock market, where
Right.
the chances are less. So I know the current market is little challenging, but in general, that's the track record for commercial real estate, particularly multifamily. Multifamily is a necessity segment. So if we get into the right investment, when obviously they need to understand what is the right investment, how to pick the right investment. That's the key. So they should get educated either online or through some mentoring programs and picking up the right investment. And once they get educated, I think they would be very comfortable investing in. So it's not that fearful compared to stock market, I would say. So they should explore this one and go slow. They should not go aggressively. First, they need to understand what would be their comfort level and the risk tolerance. And based on that, they can see which properties that meet that criteria. If they want more stable ones, they should look for higher median household income, area-based properties, and also the experienced GP syndication team who have been in the industry for a very long period of time, right? Those GP syndications, and also the properties that are more recent ones, not very old ones like 1940s, 50s type of products. You should not get in if you're doing investment first time. Try to be in the newer ones. Like that, they can put some filters, and based on that, they can screen the properties and then invest in the right one.
Yeah, I think that's great advice. So I've got one other question that I ask every guest, and that is if you have a recent book or a book recommendation. It doesn't have to be real estate related, but just a book recommendation, something you've read recently that's been impactful.
So unfortunately, I don't read that many books.
Okay.
There are very few books. Yeah. Books I would recommend Think and Grow Rich. That is a Napoleon book. I like that one. Basically, it does mindset. Other book people always recommend in real estate is like Rich Dad and Poor Dad, Robert Kiyosaki one. That changed life for many people. Rich Dad and Poor Dad, yes, both books are good for setting your mindset. Yeah, mindset is very important when we come into commercial real estate investment, because that gives that thought process and how you would differentiate yourself from traditional investing.
Right. No, I agree. And those are both great books. So,
Yep.
All right. Well, I've really enjoyed our time together, and I think you've added a ton of value to our listeners. You've added a ton of value to myself personally as well. Just listening to how you have things different, structured, and just found it very fascinating. So, appreciate you being on the Wealth Flow.
Yeah, thank you. Thanks for giving me the opportunity to connect with your listeners. And me too. And yeah.
All right. We'll call it a show.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.